Hello, in this video we're going to touch on self-employment. Basically there's three types of being self-employed. You can be a sole trader, partnership or limited company. If you're a sole trader, a lender is going to use the net profit on your accounts to assess affordability, to work out what your maximum borrowing is on a mortgage. Partnership, similar to sole trader, net profit is your share of the partnership that they're going to factor in for affordability and your borrowing capacity. Then we look at a limited company. Yes, if you've got a limited company and you've got a 25% or more shareholding in that company, then you will get pay slips, you'll take a dividend from it, and you're classed as employed. But from a lender's point of view, they're going to treat you as self-employed. So they'll take your salary and dividend and use this for your borrowing capacity. However, we have an access to some lenders, a handful of lenders, that will allow us to use your post-tax profit and your salary added back in. This we find useful for clients that have got good business, they've got a good net profit, they don't take dividends, they just take the basic salary. So we can use the post-tax profit and your salary added back in, which will give you more borrowing capacity. So how's a lender going to assess affordability? They're going to use your net profit. So what they want to do is just net profit from your sole trader or partnership, your salary, dividend from your limited company. So they'll get these and they'll take an average of the last 2 years as long as it's increasing. If it's decreasing, they're going to use the latest figure to work out your borrowing capacity. We do have access to a handful of lenders. They're going to take latest figures into account as long as it's increasing. Now we've got to be careful when accounts are increasing that there's not a big jump up. If there's a big jump, 40–50% from the previous year, the lender's going to question this. They're stress testing affordability just to make sure it's sustainable, so they're going to want to know why the big jump up, will it continue? They don't want to give you a great big mortgage and then next year your income drops down again. So they just want to make sure it is sustainable. So how do we prove the income you're earning? So what will the lender want to see? They'll want to see tax calculations. The tax calculation is a summary of all the income that you've received. So might be employed income on there if you're a limited company and you take dividends and the salary. Self-employed for sole traders, partnerships. There could be UK land income from there. There'll be all sorts. It'll list everything that you've declared to the revenue. And at the bottom of the tax calculation, it will show the tax that's liable on the money that you've earned. So if there's a tax liability, it shows how much is owed. So a lender's going to want to see a tax overviews. So a tax overview is a summary of what you've paid in tax. So the tax calculation shows what you've earned and how much tax is due, and the tax overview shows that you've paid the tax that's liable. So they come hand in hand, and a lender will want to see both. Alternatively, we can use the accounts. We can use the accounts if we're going to use the post-tax profit and salary. So your accounts will show us the post-tax profit, which again can be useful for some clients. Alternatively, lenders will approach your accountant direct and ask for a reference. So they won't ask it from you or myself, they'll deal direct with your accountant, ask for a reference, and the accountant will send it